Alright gang, welcome to part 4 of chapter 3. There will be 5 parts to this chapter just because I want to take things nice and slow because of how important it is. But we are more than halfway through, so let's get to it. Unearned revenues. And this is when our company has received cash, but we haven't earned it yet, right? And we've gone over this just a little bit, so we'll race through this pretty much. It's when our company has received cash or goods, but we haven't earned it yet, but we expect to in the future. So once we receive the cash, if we haven't earned it yet, we owe our client some sort of services. So this creates, when we owe an outside party, right, a non-owner, it creates what's called a liability. And that specific liability from a client is called unearned revenues. Real important, real easy to record that when we first get the cash, right? Let's say we get $10,000 cash, we just debit cash, and we credit unearned revenues for $10,000. What gets complicated is, as we start earning it over time, is making sure that we adjust that unearned revenues balance, right? To show that we have earned some over time. So let's take a look at an example here. Let's assume on December 26, 2011, Fast Forward agrees to provide 60 days of consulting services to a client for a fixed fee of $3,000. So I've made these simple multiples. It's $3,000 for 60 days. How much is that per day? Just divide 3,000 by 60 to come out to $50 per day. So the client pays the entire consulting fee in advance on December 26. How much revenue has Fast Forward earned when we get that $3,000 check on December 26? Think it through, right? We're going to perform 60 days of consulting services starting now, but on December 26, when we get that cash, how much have we earned? Nothing, right? Zero. So what do we first do? What's the journal entry that we're going to record? Well, of course, we're getting $3,000, so we're going to debit cash for $3,000, but we need to reflect that liability. We now owe our client unearned revenue. We would actually put this into an account called unearned revenue client name, whatever it is, Bob, unearned revenue Bob Corporation, or whatever that would be. But since we don't have one, I just put unearned revenue. And this is what it would look like if we went ahead and posted those accounts. Of course, unearned revenue now for Bob or whoever it is shows a credit balance of $3,000. That's as of December 26. However, remember, it's $50 per day. So let's fast forward to the end of the year, December 31st. That's 5 days later. Ooh, and this slide is not working. Pretend this part is not here. Just focus with me up here for now. December 31st, 5 days later. We've been earning that, right? We've earned 5 days of consulting fees because we've been providing them with consulting services starting on December 26. Each day that passes resulting in consulting fees earned of $50 per day, right? This is how we calculated that. So Fast Forward has earned $250 as of December 31st. So what's that journal entry going to look like? Remember, we need to reduce the unearned revenue of $3,000 and recognize revenue of $250. Here's how we recognize revenue and reduce the unearned revenue, right? To reduce a liability, we debit it. Remember, look at that magic slide when you're curious about that. To reduce that liability, we debit it. And to show an increase of revenue, we credit it. And don't worry about consulting revenue or services revenue. As long as you are putting revenue here, you would get that correct. Don't worry necessarily about the verbiage. Feel free to put in whatever is most descriptive and whatever our account would be. Once we do that, once we post that amount to the general ledger here, which, sorry about that, little technical difficulties. When we post that amount, that $250 debit to unearned revenue, when we actually post it to the general ledger account, you will see that that brings our balance down to $2,750, which is correct. As of December 31st, all that we owe our client is $2,750 worth of services. And that's it. That's all there is to unearned revenue. So skipping right ahead to part 3 here, the accrued expenses. And in this example, someone has provided us with something of value, right? So we owe them. And usually it's a situation where we haven't received the bill yet, but we need to take into account. What we're going to deal with, our example, is a cost that's incurred in a period, which is both unpaid and unrecorded. So the adjusting entry comes first. It's a little different. This is where I want to back up one slide here. Accruals are a little different than adjusting entries, because in the adjusting entries examples, there's a business transaction first, right? We're either spending cash or incurring debt to either prepay an expense, get supplies, or buy ourselves an asset, and then later, with the passage of time, we are adjusting those assets, or we're given cash, and later with the passage, right? The business transaction happened first, we get the cash, and later on, we are adjusting. With the accruals, it's backwards, right? We're getting the services first, and there's no business transaction because we're not getting a bill, and we haven't paid them yet. So there's no business transaction first, but we need to record it. Later, we will actually pay them, and we will be sort of adjusting it later with the business transaction. So it's almost the inverse, but let's go ahead and jump into an example, and I think it'll be much more clear what we do. I want to first get you comfortable with what we're going to be working with. I tried to find a month kind of that started on a Monday, the 1st, and ended with a couple of days at the end of the year with a Monday, Tuesday, Wednesday. This way I had to go back to 2008 and 2009. So this is just a calendar, December 2008 and January 2009. And I got a couple of dates here. These dates that are circled in red are when the pay period starts. Okay, I want you to assume that in our example we've got an employee. He works Monday through Friday, and he's paid every 2 weeks. He's paid on the last day, you see here, payday, paid on the last day of every 2-week period. So pay period starts on the 1st. He'd work 5 days in that week, 5 days in the second week, and he'd be paid on the 12th, right? And as of the 12th, we no longer owe him money, right? We've only got one employee for this example, by the way. I want to keep it real simple for you guys. Then in this next week, it would start, the pay period would start on the 15th. He'd work 5 days. We'd owe him 5 days, right? He'd work another 5 days, and then we'd pay him on the last day. What's unique here is at the end of the year, we're going to owe this employee 3 days worth of payment, right? Of payroll. He's not going to send us a bill, and we're not going to pay him on the 31st because we pay our employees every 2 weeks. And the next payday isn't till January 9th, but at the end of the year, we will owe him already 3 days worth, this 29, 30, and 31st. And that's what an accrual is all about. We need to go ahead and record the fact that we owe him money. So let's take a look. Fast forward, one and only employee earns $70 per day and is paid every 2 weeks on Fridays. So he's paid $700 cash, right? If he works 10 days and he earns $70 per day, Monday through Friday, we're going to be paying him $700 cash every 2 years. Year end is December 31st, 2008. It falls on a Wednesday. And the last payday of 2008 is Friday, February 26th. Sorry, and I'm going to go ahead and show you that calendar here. Same exact calendar we were looking at before. And I'm just putting that into words for you. From December 26th until the year end, there are 3 work days. I'm going to show you what I mean. After he's paid on this day for the last 2 weeks that he's worked, we owe him nothing. There's going to be 3 more days. He's going to work the 29th, the 30th, and the 31st. So that's 3 days. And on December 31st, we owe him 3 days worth, which is $70 per day, which comes out to $210 worth of salaries that he has earned, which we legally owe him, right? And if she's not paid until the next Friday, we have to do something to tell the world that we owe this man $210. And this is a simple example, but I want you to think about large companies who have tens of thousands of possible employees. And if they all work 3 days, we could be talking about hundreds of thousands of dollars or even millions of dollars that are owed just because of a couple of days of payroll that these people worked, right? And if the business went out, if the company went out of business on the 1st, we would still owe these people these millions or hundreds of thousands of dollars. So it's real important that we put them into our financial statements, because if we don't, we're technically not telling the truth and not giving accurate financial statements. So we need to show that we owe this employee money, $210 in our example, How do we do that at the end of the year? When we owe someone money, of course, it's a liability, right? As of December 31st, Fast Forward's employee has earned $210,000 but has not been paid, and they haven't sent us a bill, but we need to go do this accrual. We owe that employee, so we've got ourselves a liability, right? When we owe someone that's a non-owner, it's a liability. And how do we show an increase in a liability? Take a look at that magic slide if you haven't memorized it already. Increase in a liability is a credit, of course. So we will be doing just that. And here, what would it be? Salaries payable, some sort of a payable whenever we're talking about liabilities. And in this one, I think salaries payable is probably the easiest one that we could do. And most importantly, what is it to us? It's an expense, right? We've used up that person. We've incurred that expense. That employee working for us those 3 days in 2011, those last 3 days of the year, helped us earn revenue in December of 2011. So we need to match that expense with the revenue. This is where that matching principle comes in once again, right? We've used up those resources. We haven't paid him cash yet, but we've still used up that resource anyways. We now owe him. And owing is just the same as paying cash. Remember, cash changing hands is not important for revenue recognition purposes or expense recognition purposes. It's when we incur expenses. So again, we owe him the $210. We credit a liability called salaries payable, or whatever the most logical name of a payable would be if we're talking about something else. And of course, we need to recognize the expense. To show an increase in expense, we of course debit it. And that's all there is to accruals for the most part. If we go ahead and post that entry to the ledger, and by the way, I had already posted the entries from before for you, we would see that the salaries expense for December of 2008 would have been $1,610. Had we not done this last adjusting entry, we would have only had $1,400 of expenses, which would have understated our expenses, which we cannot do. In most cases, that is illegal for us to do. And we would have been underestimating our liabilities. We owe this employee $210,000. This accrual that we've just done helps to reflect the proper liabilities and the proper expenses in the year that we just finished out. Now, one thing to think about is, of course, on January 9th, 2009, so our next payday into the next year, right? We're going to go ahead and pay $700 to that employee, right? Because we didn't pay him the $210. We just recorded the fact that we owe him $210 here, but we haven't paid him. We're going to pay him on the 9th. So when we do pay him on the 9th, that's $700 for the 2 weeks. These 3 days, these 2 days, and these 5 days. What would that journal entry look like? Well, $700 cash is going out the door, so we're going to be crediting cash for $700. But real important to think about the other side, right? These 7 days are going to be a salary expense, right? Because we are matching the expense of these 7 days with the revenues in January. But what's the $210 balance going to go to? Yeah, remember, if we go back one step here, we created this liability that we owe our employee. The salaries payable, we owe him $210. And when we pay him on the 9th, we no longer owe him that $210. So we need to eliminate that payable, right? So we will actually be debiting the salaries payable for $210. This is what it looks like to show that we no longer owe that employee $210. And this $490 shows the salary expense that we incurred in the new year for the 7 days that he's worked in that new year. And of course, the cash part is simple. This is why I always say, deal with the cash if cash is involved first. That's almost always the easiest, clear-cut, and simple part of the entry to do. Then go back and use your logic and reasoning to figure out the other parts of it. And just showing you what the posting of those entries would look like then. So the salaries payable, once we post this entry, shows we no longer owe our employee anything, which is absolutely correct, and the expenses. So I'll see you guys in just a bit for the conclusion of Chapter 3. That'll be Part 5, and where we'll go over